Jeffrey, given sticky inflation and higher interest rates, what allocation level to real estate assets makes sense right now?
Yeah, so as you say, inflation's been a bit stickier than the Fed has been targeting. That's really been true for the last couple of years. We think that means that real estate and real assets generally should probably be at least 10% of an allocation. It's probably more than most people have in their portfolios.
And what is your Fed forecast? It seems like they've given up on that 2% level to fight inflation.
Yeah, so we got one cut. We think we'll get another cut or two, which is very much priced into the market between now and the end of the year. I think where we differ a little bit is we think we probably get fewer cuts in 2026, mostly because growth is staying a little strong. And as you say, inflation staying a little bit stickier. Fed composition might matter, but we think that they'll probably do a little less than is discounted today.
Well, real estate also has the wind at its back because even the president wants more private market assets in retirement accounts. What are your thoughts?
Yeah, so there's the world of private assets and there's the world of listed assets. Real estate actually sits in both of those worlds. I think real assets generally play a great role in portfolios, and that can be done in listed markets, right? Ones that trade every day. That could be a real advantage compared to some of the private markets, but the growth in retirement assets in general is likely to help the real asset categories.
The disadvantage, of course, is illiquidity. And sometimes cost. Can you address those?
Sure. So illiquidity plays one advantage insofar as if you have a bit of a downturn, people can't sell it at the lows. The challenge with liquidity is if you need to get that money back sooner, you don't have it. There's an opportunity to put listed markets alongside private markets in portfolios. That allows you to get the benefit of the long-term returns, smooth out volatility a little bit, and have the liquidity when you need it.
Okay, there's residential and there's commercial real estate. So let's talk about commercial. What is the state of the commercial real estate market right now? For a long time, people thought it was going to be the shoe to drop because people weren't coming back to the office. But now people are coming back to the office.
The commercial real estate market is actually much more diverse than maybe most people realize, especially within listed markets. Office has gone through a period of weakness. It actually looks like it's starting to bottom and pick up a little bit. Depends a little bit on what market you're looking at. But there's other markets that have done really well and that have really strong secular drivers. Things like data centers, which benefit from AI. Things like healthcare, where you have senior living that benefit from demographics. And even parts of the retail market as well. Especially within private markets, we've really liked some of the retail spaces that you can get. That's, those are markets that are doing very well against what's been, as you say, from the headlines, pretty tough for real estate overall.
And then just quickly, what about the residential side? Because we got a Fed cut and it really didn't move rates down that much to help the mortgage market.
Yeah, the challenge with the residential piece is that there's been two main issues. One is that house prices themselves are pretty high. And number two is that mortgage rates have risen a lot over the last 4 or 5 years. That means people's mortgages might be locked at much lower interest rates than where prevailing mortgages are today. Getting all of those things to loosen up will probably take time. And honestly, mortgage rates a whole lot lower than where they are today.
So finally, over at Cohen Steers, how are you telling advisors and their clients how to allocate assets into real estate?
Yeah, so we think, as I mentioned before, that real assets should be a bigger part of portfolios generally. Real estate is a piece of that. We think that real assets offer good return potential going forward, diversification, and really some different exposure from the concentration that we're seeing in cap-weighted indexes, where you have the top names in the market really driving the vast majority of moves.
All right, well, thanks a lot for coming on and talking about it.
Thanks, Greg. Good to see you.